Hi, everyone. Today, for our series on maximizing value at an exit, we're going to focus on the structuring considerations. I'm Jay Jung, principal and founder of Embarc Advisors. In my prior life, I was an investment banker at Goldman Sachs. I also did corporate finance consulting with McKinsey and Company. And about 20 plus years ago, I did a network security startup, raised money from VCs, which ultimately didn't pan out. And so our goal at Embarc Advisors is to bring that Goldman McKinsey toolkit to the middle market and help companies grow, thrive, and eventually exit with the maximum value. So as a firm, we started off as an M&A advisory firm doing buy-side and sell-side work. And then we realized that a lot of companies don't have exit-ready financials. They might have a good controller, might be doing accrual-based accounting, but they don't have exit-ready financials. So we built out a quality of earnings teams to prepare a company for an exit and maximize EBITDA at time of sale. And even then, we noticed that some companies are leaving a lot of low-hanging fruit on the table. And if there was a strategic-minded CFO that has gone through several exits, they could help the company optimize for value, maximize the take-home cash and everything. So we built out a strategic CFO services team that can help companies get ready for an exit, whether it's 12, 24, or sometimes 3 to 5 years. So Warren Buffett often emphasizes that the structure of a deal matters as much as the price. And so when we see a company and run a process, valuations can often vary significantly. The valuation is almost always a range and is not a point estimate. And when you layer in structure, it varies even more. So you can see some deals are all cash. Some deals have a good amount of earnouts or rolled equity or seller's notes. So it really varies. And what we want to emphasize today is, the valuation is EBITDA times multiple, but structure is what really influences the take-home cash to a seller. And by structure, we're talking about the deferred consideration, such as rolled equity and earnouts and seller's notes, and also taxes. And structuring influences all of these. So today I'm going to talk about rolled equity, then earnouts, and then third, taxes. So first of all, what is rolled equity? So rolled equity is where you reinvest a portion of your sale value into the acquirer. The pitch that buyers often make is that when the acquiring company recapitalizes or sells, you will get a second bite, which will be 3 to 5 times the value of your rolled equity in approximately 3 to 5 years. So what are the benefits? First of all, as a seller, that rolled equity is done on a pre-tax basis. So you get to reinvest with pre-tax dollars. And obviously, you have that second bite opportunity. The consideration is that cash is going to be tied up, and there's no real clear end date. Second, it's going to be most likely a very concentrated investment for most sellers. And lastly, frankly, the returns are uncertain. So the key issues to consider when deciding on rolled equity is number one, how much to invest. Number two, what's the price per unit? And number three, what are the terms of that rolled equity? So the most common question I get is, how much should I roll over? So then I ask, well, what is the best company in the world? Is it Meta, Google, Nvidia, OpenAI, or Microsoft? So now let's pick one and say that you have to invest $3 million to that one stock, and you can't sell it for 3 years, maybe five, it could be longer. How much would you invest in that situation? And when I ask that question, a lot of people say, well, I don't want to invest $3 million. That's a lot of money. And who knows what can happen in 3 to 5 years. And that's exactly what rolled equity is. You're choosing one company that's not the best company in the world under the same situation. So when you look at the numbers from 2018 to 2024 for middle market private equity, the median multiple on invested capital. So if you put in $1, the median return is about $1.50. It's a 1.5 to 1.6x return for most industries. The top quartile funds get about 2.5 to 2.8 times, still below that 3 to 5 times multiple. And look, I have no doubt that when private equity invests in these companies, they are truly underwriting a 3 to 5 times multiple. But as we all know, things don't always go as planned. So sometimes you get that 3 to 5 times. Sometimes you get more. Sometimes you get 10 times multiple, and sometimes you don't. And for that reason, the median of the top quartile is a little bit less than 3 times. And it's also worth bearing in mind that a 3 to 5 times multiple in a 3 to 5 year horizon, that implies a 25 to 40% annual return. That is very high, very high. Just kind of keep that in mind when you think about that second bite and what's more realistic. Now, the second point around rolled equity is price. As Howard Marks emphasized, the price of an asset is the single most important determinant of the return that you're going to earn. What does that mean? Let's say you roll $2 million in equity, and the private equity firm gives you that rolled equity at $1.30 per unit. Now, 4 years later, they sold. The price of the unit is now $3.90. You made 3x. That's a pretty good return, and your 2 million becomes 6 million. But what if in the beginning you negotiated the price per unit to $1 and it's still sold at $3.90 per unit? That means you made almost 4x. And that's an additional 1.8 million in this scenario. So negotiating that price per unit at the time of sale is paramount in maximizing your return. And I see very few people actually do this when they sell their business. Lastly, the rolled equity is a significant minority investment in private company, private units in this case. So there's a lot of things you can negotiate. It's not like buying shares of a public company like Microsoft. What class of shares are you getting? Are you getting Class A, Class B? Do they have voting rights? What information rights do you get? Do you get to be on the board or have a board observer seat? Do you have pro rata investment rights, tag along rights, liquidity preferences? These are all terms that can be negotiated when you're investing, when you have a significant minority investment in a private company. So 3 things to consider when you're looking at rolled equity. How much to roll, considering the expected value of the rolled equity returns, what price to roll at, and what terms. And so it's very important that you do buyer diligence when you take a significant rolled equity portion in your deal. Now, moving on to earnouts. So an earnout is a part of an M&A transaction where part of the purchase price is paid later, contingent on achieving specific financial or operational milestones. Now, buyers like this because it makes it look like they're paying a higher headline valuation with less cash outlay upfront, and it gets to mitigate risks, say key client retention, growth goals, etc. Now, of course, the consideration is that it makes the deal less attractive to the seller. But for the seller, the earnout can be a very valuable tool to bridge the valuation gap. So if the seller thinks the company is worth more, the buyer isn't convinced, you can use an earnout to bridge that gap. Now, of course, there's a risk that you, as a seller, might not earn it. There's a risk that it could become a potential source of conflict post-sale. And bear in mind, at this point, the conflict is with the company owner or your boss. So it's an uncomfortable position to be in. Now, here's a real life example. This is not something that we pulled together, but we received this from an investment bank where you can see the revenue was relatively flat for the last 3 years. And then it started growing in the forecast period. And the margin started expanding to levels that's never been in the forecast period. What happens is then the EBITDA starts to hockey stick like you've never seen before. So what happens if the buyer says, okay, well, we'll set our earnout based on 2027 EBITDA numbers? I'm going to guess that most likely they're not going to hit that earnout. And that's what happens. If you look at a study by SRS Acquium, 4 out of 10 deals get paid 0 of their earnout. Only 59% have a partial or full payment on the earnout. And only 21% of the aggregate earnout potential is actually paid out. So if there's an earnout, there's a good chance you're not going to get the entirety of it. So there are 3 defining factors in an earnout. 1, what is the target metric? 2, how do you define that target metric? And 3, what is your ability to forecast that target metric? So from a seller's perspective, revenue is the best. It is the easiest to measure. There's the least amount of ambiguity. But a buyer, in this case, let's say private equity, will prefer an EBITDA metric because that's how the company is valued, and that aligns with the valuation driver. EBITDA also has the most accountability. You can't grow revenue at a lower price, say low gross margins, and you can't grow revenue by spending a ridiculous amount in sales and marketing. Now, a hybrid approach that we've tried in certain instances is where the earnout is based on revenue, but there's a minimum EBIT margin target. So it's really important to choose the right metric to ensure that you attain that earnout. Now, the next thing is, how do you define that earnout? And here are the most common mistakes that we see. The default language is almost always to say that the earnout will be based on generally accepted accounting principles. Now, that seems perfectly benign. Of course, we're on GAAP. We do accrual accounting. Why wouldn't we define our earnout based off of GAAP? That's your first mistake. Because first of all, adjusted EBITDA is not based on GAAP. Your accounting is most likely not fully GAAP based. For example, we see very few middle market companies do accrue for paid time off, accrue for bad debt expenses, and there are certain other GAAP practices that a lot of middle market companies don't follow. Now, also bear in mind that a buyer may impose additional overhead costs. They might not be on QuickBooks. They might be on a much more expensive ERP like NetSuite. Their employee benefits might be much better than yours and more expensive. As a bigger company, they might have other compliance and insurance requirements that all add to your overhead. And lastly, make sure the earnout is defined as a pro rata sliding scale, not a black and white cliff. So the recipe to earning the earnout is, first, you have to start beginning to improve your ability to forecast. If you cannot forecast your metrics, then you're just gambling on hitting that earnout. Number 2, make sure you understand your accounting principles and define those in the purchase agreement. Number 3, anticipate the pro forma changes and ring fence your EBITDA definition so you don't get hit by those extra costs. And lastly, define the language of adjusted EBITDA in the purchase agreement. So if we go back here, as mentioned, valuation is EBITDA times a multiple. You subtract the deferred consideration, whether it's rolled equity, earnouts, or seller's notes, and then you got to pay taxes, and that is what's left for cash to sellers. So let's talk about taxes. Mitigating taxes is all about structuring and advanced planning. On the corporate structure side, there's a tax impact, whether it's an asset deal or a stock deal. The other tactic we're going to talk about is qualified small business stock. And lastly, there's also you can do a 1045 exchange. Aside from all the corporate structuring, there's a myriad of activities that you can do on the personal side to mitigate taxes, which we're not going to go into in this presentation, but it's worth keeping in mind. So stock versus asset deal, what does this really mean? It really comes down to 2 factors. Where does the residual liability sit, and what's the tax impact? In an asset deal, the residual liabilities stay with the seller. Because the buyer is buying all the assets, the LLC or S Corp or C Corp sits with the seller. So if some liability comes up post-sale, that is still the seller's responsibility. Also, in an asset deal, the taxes are more favorable to a buyer. So generally, a stock deal is better for a seller because the residual liabilities also travel across to the buyer, and the taxes are a little bit more favorable to the seller. Now, there is a hybrid option where you can do a stock deal with a tax basis step up. In this case, the liabilities travel across to the buyer as it's a stock deal, but the buyer gets to treat the transaction as if it's an asset deal, so gets the favorable tax outcome. So just something to consider as you think about the deal structure. Now I want to get to the meat of the discussion around tax planning. So QSBS is probably the most powerful tax planning tool that a business owner has. And so what is QSBS? If a business owner holds the investment or the company for 5 years in a C Corp, that is a qualifying business category. Up to 100% of capital gains can be excluded, up to the greater of 15 million or 10x the basis. And with the recent passing of the OBBBA in July, it's gotten even better. Before, it was a 5-year holding period or nothing, and now you get to gradually grow into the exclusion. So after 3 years, you get 50% excluded. After 4 years, you get 75% of your capital gains excluded. And after 5 years, same as before, you get 100% excluded. And the exclusion amount increased from 10 million to a 15 million base exclusion amount. So what does that mean? Let's say your business is worth $15 million. If you sold it today, you'd pay 3.6 million in federal taxes. That's a 23.8%. If you convert to a C Corp, that's QSBS qualifying, 3 years later, you will get 50% gains exclusion. That means your tax bill drops to 2.4 million. 4 years in, you get 75% exclusion. That means your tax bill is now 1.2 million. 5 years in, 100% exclusion, you pay zero federal capital gains taxes. And if you are in a QSBS conforming state, you'll pay zero state taxes as well. Now, QSBS is a very specialized niche topic. And so typically when someone hears this presentation, they go to their CPA and they say, I heard this great presentation. I'm going to convert my S Corp to a C Corp, and I'm going to get QSBS. Well, you get a lot of pushback on that. The first thing that I often hear is, you're not eligible for QSBS because your business is an LLC or an S Corp. I want to let you know, it is possible to restructure an S Corp via F-reorg to a C Corp to take advantage of QSBS, but it has to be done right. The second pushback is, C Corp is not good for you because you're going to incur double taxation. I also want to point out that it is possible to structure the corporate entities to reduce double taxation leakage. Now, some owners say, I can't wait 5 years. So the good news is the OBBBA just made it easier so that even after 3 years, you get 50% exclusion. But if you have another business, and a lot of business owners have multiple businesses, a side business, if you have another business that is QSBS qualifying, you can do a 1045 rollover so that, let's say you sufficed a year and a half or 2 years in the first business, and then you roll it over the second business. You just have to wait out the remaining 5 years in that second business. Lastly, some people will say PE doesn't do stock deals, and I'm just going to say that's not true. And here's a real life example. It's a 1 million EBITDA IT services company where we ran a process, got 11 bids, and you can see not only did private equity do a stock deal in a QSBS conforming transaction, they were the top bidders. So I think real life examples speak more than theory. So the last question I get is, well, this sounds too good to be true. Why isn't everyone doing it? The reality is, this has only started to be meaningful in the last 10 years. Until 2013, the tax rate was only 15%. QSBS didn't have a huge impact. Furthermore, until 2009, QSBS exclusion was capped at 50%. So it didn't really make sense to go through all of this. So it's only starting in 2013 where the tax rate went up to 24% and you got 100% exclusion that it started to be meaningful to take advantage of QSBS. So hypothetically, if the first company was formed in 2013 to take advantage of this kind of new QSBS paradigm, it's only after 5 years in 2018 that this company would be eligible to take advantage of the QSBS benefits. But as we all know, it generally takes more than 5 years to build a company that is ready for a sale. And that's why it's only now that you're starting to see more and more companies take advantage of QSBS at exit. It is, in the grand scheme of taxes, it is a relatively recent phenomenon that QSBS has become meaningful. And that's why not everyone is doing it. As I mentioned, it's a very niche topic. But I do think going forward, it will become more and more popular, and you'll see more companies that are selling as C Corps to take advantage of this. So to wrap it up, I like to say multiple is what you talk about, but structure is what you keep. So as we know, valuation is EBITDA times multiple. And as I've mentioned before, how do you maximize your EBITDA at sale? You do a seller's quality of earnings. The seller's quality of earnings identifies all the adjustments and then loads that all up in a fashion that can be marketed to buyers and, most importantly, can be defended in buyer diligence. How do you maximize the multiple? Well, that's all about strategic finance. Strategic finance will drive the multiple so that for the right buyer, they will ascribe a premium valuation. So EBITDA times a multiple gets you to valuation. Now, what determines the cash at close to the seller? That's deferred consideration, rolled equity, earnouts, seller's notes, and taxes. And all of those are impacted by structuring. And that's why, as Warren Buffett often emphasizes, structuring is just as important as valuation. So takeaways for today. Number one, think long and hard about that rolled equity. Number two, it's not about the amount of the earnout, it's about how much you attain. And number three, taxes eat up a quarter to a third of your proceeds. Plan earlier and you will save more. Thank you. Again, my name is Jay Jung. I am principal and founder of Embarc Advisors. This is a firm that we started 7 years ago with the goal of bringing that top-level advisory to middle market businesses as they continue to grow, thrive, do acquisitions, raise capital, and eventually sell. And when they sell, we want to help them achieve all of that. Maximize their EBITDA, maximize their multiple, and put in the best structure so that our sellers go home with the maximum amount of cash. Thank you very much.